Similar to chart pattern example case study 33, GDX, HYG also demonstrates chart pattern analysis across multiple market influences since it is a bond ETF traded on the stock market. In terms of the general characteristics shown by the chart, there are usually long periods of low activity, in between sharp movements that are usually short in duration. Here is a period of high volatility for this kind of ETF. August has some rapid fluctuations during the formation of a compact double bottom, reversing a relatively minor downswing. Price action is neatly contained within the outline of the strict double bottom range. This is a variation where the bulk of a volume takes place during the first half of the pattern, rather than the second half upon its completion. Nevertheless, it presents an overall decrease in bearish volume and an increase in bullish volume to accompany the double bottom price action. Although bearish price action and volume are not exceedingly strong into September like earlier in August, there is still stiff opposition at the clear resistance range from recent highs. This also converges with the breaking of the uptrend line, originating from the double bottom that is naturally followed by more neutral to bearish movement. Here is a case when a bullish reversal pattern is countered by its bearish counterpart, as October sees the clear completion of a double top. The double top has a less strict outline compared to the double bottom. Technically, the lower boundary would be around 86.60 at the site of the upswing that started September. But since the double top is relatively small, it straddles the boundary between the strict M outline and a less strict double top with downswings aligning around the 87.40 area. In any case, the price action isn't as neat, and overall, it is a small drop out of the 87s. A longer-term uptrend line encompasses a bullish reversal with the same general features as a double bottom range. Over the course of 7 candles for some very small but sharp upswings into early October. A swift downswing from the central 87.40 range leads to the breaking of the uptrend line and the normal shift to more neutral price action. The overall uptrend has been altered rather than conclusively ended, as December sees another bullish spike, along with even less bearish volume and price action. In the short, medium, and long term, there is an overall bullish background, sloping up towards the clear 87 resistance range. A more comprehensive uptrend line stemming from the June upswing summarizes persisting bearish sentiment within the last 6 months beginning to decline, both in terms of bearish volume and the progressively smaller magnitude of each downswing. As noted earlier, this chart doesn't usually have overwhelmingly high activity. That means the recent surpassing of the gap down fill at 87 with mainly normal volume levels is not out of the ordinary, especially since December has been predominantly green so far. The uptrend over the past 2 weeks has been riding a very advantageous tailwind, given the large bullish context. Mid-December sees the eventual close over 87.60 to complete the larger ascending triangle. This pattern and the larger uptrend before it are quickly under pressure as bullish volume and price action rapidly subside into the new year, while heavier selling emerges, with major volatility that still sees the major 87.40 area hold for a brief time, with the approximate outline of another compact double bottom. As would be expected, there is still some support slowing down the overwhelming bearish move, due to the approximate area where the longer-term uptrend line and the 87 range intersect. This is also still within the approximate influence of the ascending triangle. Upon the definitive break of the uptrend, there is a normal bullish retracement back towards 87 that unsurprisingly reverses roles once again to offer firm resistance during a progressively more volatile downtrend. Since ETFs are approximations of a group of assets, it is more common for their charts to have gaps that are nearly but not completely filled. Most of the assets in the ETF are reversing around the gap area, but some will perform better or worse. The resulting movement of the ETF is a general reversal that doesn't necessarily return back to the exact gap fill area. This is one such case. There is also residual influence from the downswing high in late March at 78.37. In addition, this is also during an increasingly aggressive uptrend developing into May. So while it would be perfect to have upswings form right at the gap fill, it is not always going to happen.